Hello, my name is Jerry Miller. I'm the founder of Trendsignal, the trader education company, and this is part of our Monday Market Insight series. And today I'm going to be looking at the UK economy and sterling. For those of you who follow the markets quite closely, or those that don't, will have seen the headlines over the weekend. Sterling particularly weak, slumping against the dollar, and also significant downgrades by the IMF, not just on the UK economy, but on the global economy. So let's have a look at what the IMF actually said. The International Monetary Fund, they put out various forecasts, and they did one in January, and they've updated it now. And you may think, well, gosh, it's quite quickly to do these updates, but obviously January is before the Ukraine war, so a lot has changed since then. But they're expecting global growth to be 3.6%, which is pretty strong. But that's down from 4.4%, which was predicted in January before the war. More importantly, the UK is expected to see slower growth in a similar sort of percentage move, as it were, in 2021 of 3.7%, and that's down from 4.75%. But it's really next year that the IMF predicting that the UK growth will be a lot lower at 1.2%. Originally, that was predicted at 2.3%, so it's virtually half what they were predicting just 4 months ago. And this will actually place the UK at the bottom of the developed country league table, as it were. Of course, the IMF doesn't always get it right, and it didn't predict what happened post Brexit. And its record has not been brilliant predicting UK economic activity, but obviously time will tell. So, more about the UK economy and sterling. Sterling has had a significant fall, having fallen through the 130 level here. I'm just showing a chart of sterling against the US dollar, and you can see on the far right of the screen here a significant fall against the US dollar, breaking through the 130 level for the first time. Gosh, I think way back to November 2020. But this is a significant fall on, as I am talking to you now, Monday morning, you can see we've fallen further to 127.40 odd. But it's also, sterling has also fallen against the euro a little bit, but it's really most pronounced against the US dollar. And really, a lot of it is down to a fairly dire report on retail sales that we received on Friday, showing that retail sales had fallen by 1.4%. This is the second monthly fall in retail sales. And really, traders and investors are speculating that the Bank of England will tilt its bias to a more sort of dovish side if economic activity continues to slow. So if interest rate expectations start to wane a little bit, that's why sterling has fallen the way it has. So the projections for future interest rate rises are starting to be dialed back a little bit, causing sterling to fall as much as it has. So, what are the implications for or the effect of a weaker currency, a weaker sterling on us? Um, the implications, well, mostly inflationary. In times of low inflation, no one really bothered about weaker currencies, and there were a lot of competitive devaluations of the yen, of the euro, even, and to a certain extent the US dollar. But in times of high inflation, there are big concerns that you import a lot of inflation with a weaker currency. So take, for example, all dollar-based commodities such as precious metals, base metals, copper, zinc, aluminium, they're all traded in dollars. You will see all these prices rise significantly or in line with the fall in sterling against the dollar. So that'll have a big effect. Overseas holidays will cost more. We'll have to look out for fuel surcharges already with the jump in oil, but now we're going to have to contend with higher costs when we travel. So when you have your overseas holiday, you'll find that the foreign exchange swap, when you swap your sterling for euros, swap your sterling for dollars, swap your sterling for Swiss francs, you're going to get a lot worse rate. So one of the issues or concerns we have is what about inflation? What about a recession? Are we going to suffer from both? Neither. The Bank of England were one of the first central banks to start raising rates. In the wake of the poor retail sales, the governor of the Bank of England, a chap called Andrew Bailey, described his job as and the job of his rate setting committee, the MPC, as walking a tightrope between tackling inflation and avoiding recession. And this was said last Friday in the wake of the poor retail sales figure, and it sort of suggests that he's tilting towards cutting back or dialing back, as I've said, the number of rate rises that they're considering. But the big worry is stagflation. This is where growth slows or stagnates. When this happens, it's usually accompanied with a fall in price pressure. So when economic activity declines, you've got less economic activity, less pressure on rates. So you normally have an accompanying fall in inflation or inflationary pressures. But with inflation very much a global phenomenon, it's very possible that the UK continues to suffer from inflation, even with a drop off in economic activity, like we're seeing as exhibited in the retail sales. And this persistent pressure in price pressure or inflation, allied with a drop off in economic activity or even a recession, is known as stagflation. It's probable, but it's not probable, but it is possible. And if we get more poor data, it's more likely to happen than less. And so it's something that will be a big concern to Andrew Bailey and his rate setting committee at the Bank of England. And obviously, it'll have continually negative effect on sterling as we trade well below that 130 level against the dollar. Further pressure to come, possibly. Thanks very much.